Welcome to The Explainer. Today, we're going to decode one of the most fundamental concepts in all of business, cost. And I'll show you how really understanding it can be a strategic superpower. So let's start with something really simple. Think about the t-shirt you're wearing, or your favorite one. You know what you paid for it, sure. But have you ever really stopped to think about what it took to create it before it ever even got to you?
I mean, we know the price tag, right? But what did it actually cost to make? You've got the cotton, the ink, the wages for the person running the printing press, the rent on the workshop. It all starts to add up.
And getting a handle on that true cost? Well, it's not just some boring accounting exercise. It's genuinely one of the most vital skills in business. If you know how to measure and classify costs, you unlock the secrets to smart pricing, efficient production, and of course, profitability.
Okay, let's dive right in. The thing is, when we talk about cost, it turns out we're talking about something that has to serve two totally different masters, and each one has their own set of rules and their own goals.
On one side, you've got financial accounting. This is all about reporting to people outside the company, investors, banks, the government. It's super strict, it has to follow a set of rules called GAAP, and it's all about looking backward at what already happened. But on the other side, you have management accounting. This is for the insiders, the managers actually running the show. It's flexible, it's forward-looking, and it's all designed to help them make better decisions tomorrow.
To really get how this works, let's put ourselves in the driver's seat. Let's imagine we're running our own custom t-shirt business. What are the actual costs that go into making just one of those shirts?
So pretty much every physical product has three basic cost ingredients. First up, direct materials. This is the actual stuff you can touch in the final product. You know, the blank shirt, the ink. Next, you got direct labor. These are the wages for the people who are physically making the product. And finally, the big one, manufacturing overhead. This is the catch-all for everything else you need for the factory to run, but that you can't pin on a single shirt. Things like rent, electricity, or the supervisor's salary.
Now here's a really crucial idea. Some of those costs literally stick to the t-shirt. They get bundled up into an asset called inventory. We call these product costs, and they only turn into an expense when that shirt is actually sold. But other costs, like the marketing department's budget or the CEO's salary, those aren't tied to making the product at all. Those are period costs. They get counted as an expense in the month or year they happen, no matter how many shirts we manage to sell.
But here's the thing, costs aren't static. They don't just sit there. They react and change based on how much stuff we're making. And understanding this behavior is absolutely key to managing a business well.
Okay, check this out. This is a perfect picture of variable costs. Think about the ink for our t-shirts. The cost of ink for one single shirt, it's always the same, right? Let's call it $1. But the total amount we spend on ink, it climbs in a perfect straight line with every single shirt we print. More shirts, more total ink cost. Simple as that.
And now for the magic trick of business, fixed costs. Our workshop rent, let's say it's $1,000 a month. That total cost is a flat line. It doesn't care if we make one shirt or 10,000, but look at what happens to the cost per shirt. If we only make one shirt, its share of the rent is the full $1,000. But if we make 10,000 shirts, the rent cost for each one plummets to just 10 cents. That is the power of scale.
And, of course, in the real world, things get messy. Some costs are a mix of both. Imagine we rent a machine for a flat $500 a month plus 50 cents for every shirt we print on it. That cost has a fixed base, and then it goes up with volume. We call these, you guessed it, mixed costs. Okay, so we have all our building blocks, right? Product versus period costs, fixed versus variable. Now we get to the big reveal. Because how you decide to assemble these pieces can tell two completely different stories about how profitable your company really is.
The whole debate boils down to one single question. What in the world do we do with those fixed factory costs, like our workshop rent? Absorption costing, which is the official method for public reports, says that rent is part of making the product, so it should get attached to the t-shirts as a product cost. But variable costing, which is for internal decisions, says, whoa, hold on a minute. The rent is a cost of the time period, not the shirt, so it should be expensed right away.
And this chart just lays it all out perfectly. See that one box? Fixed production costs? That's the battleground. Under absorption costing, it's a product cost, meaning it gets absorbed into the value of your inventory. Under variable costing, it's treated as a period cost, and it hits your expenses immediately. One small change with huge consequences.
This one little change totally re-engineers the income statement. The traditional report gives you a number called gross margin, but the variable costing statement gives managers something way more powerful, called contribution margin. That number tells you exactly how much money each sale is contributing to help cover all those big fixed costs.
All right, enough theory. Let's see how this plays out with a real example. So, meet the Fortis Company. In their first year, they made 200,000 units of their product, but they only sold 180,000, leaving 20,000 sitting in the warehouse.
So using the official by-the-books method, absorption costing, their income statement showed an operating income of over $4.4 million. Looks pretty good, right?
But when the managers looked at their internal reports using variable costing, the profit was lower, about $40,000 lower. So what gives? Which number is the real profit?
And here it is, the solution to the whole puzzle. That entire $40,000 difference is the fixed factory overhead, $2 a unit, that got stuck to those 20,000 units they didn't sell. Instead of being an expense for the year, that cost is now sitting on the balance sheet as an asset, just hidden inside their inventory.
So this table basically gives you the golden rule, the cheat sheet for this. When you make more than you sell, your inventory goes up, and absorption costing will always show a higher profit. But when you sell more than you make, your inventory goes down, and then variable costing will be the one showing the higher profit.
So you might be thinking, why bother with all this? Why have two different systems? Well, it's because one of these is way more than just a report. It's a strategic weapon for making smart business decisions.
For anyone actually running the business, variable costing is just flat out better. It gives you a crystal clear view of how profits really change with sales volume. And crucially, it means a manager can't make their department look good just by overproducing and stuffing the warehouse full of inventory. And that contribution margin number we talked about, it's pure gold for figuring out pricing and which products are actually making you money.
So when you peel it all back, speaking the language of cost isn't just for accountants. It's a toolkit for strategy. It tells one story to the outside world and a much more revealing, useful story to the people inside making the decisions. Which leaves us with a final tricky question to chew on. If making more stuff makes each item cheaper, does that mean a company should just always produce as much as it possibly can? Or is the real secret to profitability found somewhere else entirely?